All right, we got about 8 minutes till the bell. Nate Peterson joins us, Director of Derivatives Analysis at Schwab Center for Financial Research. All right, Nate, so we've got S&Ps is seemingly kind of maxed out here at 53.65. What are you watching into the close?
Basically, this continued melt up in tech. I mean, it's really the S&P is doing what it's doing, on track for another record close because of technology. The money continues to, Apple's definitely contributing today's, bullish sentiment in tech. Technically, you can't really argue much with the NASDAQ composites that's hitting fresh new highs. You have to respect it as a trader. You can look for, the best thing you could do is look for any kind of reversal patterns, any kind of candlesticks, anything like that, shooting stars, bearish engulfing, any of that kind of stuff. It's not showing up on the chart. So we're here during June, which you could see some volatility. It's not in the VIX market out there. If you look through the summer, we don't, on the term structure, we don't even get out to 15 until we get into September. And then you see a big jump, so to speak, relatively speaking, to above 17 because of the elections. But Oliver, it's just melt up mode, respect tech, and, don't fight the trend.
Does that suggest VIX could go even lower here? We were looking at a trade someone put on earlier. KG was looking at a bullish VIX risk reversal. Someone thinking for a big spike tomorrow. But it seems like if we don't get anything disturbing, then the melt up would suggest VIX just keeps sinking.
Yeah, and if you're getting these types of daily changes in the S&P 500, 0.16% higher, if this continues on a consistent basis, yeah, you would expect the VIX to just bleed kind of lower, because at 12 or 13, it would be overpriced unless you're getting roughly a 0.75% move on a daily basis, one way or the other in the S&P 500. It's just not happening. And the data is such that, it's not enough to elicit a Fed cut, or I don't expect a lot of changes from the message that they've been conveying for most of this year. And then it's not getting too hot to where we'd look at potential rate hikes, or we're not seeing inflation really reaccelerate. So it's like in the absence of any news that's going to be as enough of an outlier, any of the data that's going to be enough of an outlier to move us one way or the other, we just kind of generally grind higher is what it seems was going on right now.
Okay. As the grind continues then, where do we kind of expect the seasonality around? Well, not only do we have an election, but we've also got, we're in kind of the middle of the summer here. Isn't there something to be said that generally until we get into the election, craziness, that vol kind of slips through the summer?
Yeah, I think historically speaking on an election year, yes, and it's generally bullish for stocks. If you look at June over the past 20 years, though, June is not a good month. It's basically, it's like the third worst performing month over the past 20 years.
All right.
And then, in the back half of June, when you start to get, some of the positioning and the rebalancing around the Russell and those types of things, yeah, that last, if there's going to be some volatility that's going to come up, yes, it could come tomorrow if the Fed does something, or the CPI data comes in, outside of the expectations there. Or I would look to basically that last week of June. Perhaps we get a volatility tick up there.
Okay. So that's a good timeline for us then. If we can survive June, then maybe we're kind of in the in the clear coast, perhaps. Valuation-wise, when we think about how far markets have come, Nate, does it look like we need to break in your mind, or have we had enough earnings growth to at least keep us? I mean, we're still below the COVID, mania.
Yeah, it's fully valued, no doubt. I mean, we're above the 10-year average. It's around 18. If you look at FactSet. If you look at the average 10-year yield, which you need to take into consideration, it's below 3 over the past 10 years, and we're at 4.4. That gives you a sense of how fully valued we are. But then you have the AI secular growth story, and that's what's really allowing valuation to be where it's at because of the potential that's there. Having said that, so we get to July, we're already going to be looking for earnings as we start in mid-July. I'm going to be looking for that whole enterprise cloud software spend narrative in terms of the weak guidance and a lot of the cautious spending there. And I'm wondering whether that money is going towards AI, or is that legitimately indicative of some kind of a slowdown from the long and variable lags that we've seen from the interest rates? We'll have a better sense once we get another quarter of earnings in July. So look for software, cloud, enterprise spend, and see if there's anything to the narrative that we got here over the past couple of months.
All right. Yeah, good stuff. So we've got some fun earnings here to keep that on the top of our mind, too, with Oracle coming out after the bell. Good stuff, Nate. Appreciate your time.
Thank you.
Taking us into the finishing couple minutes here. Nate Peterson, Director of Derivatives Analysis at Schwab's Center for Financial Research. All right.